With the provision of deposit insurance and the doctrine of too big to fail, banks and their depositors were protected even if they made bad investments. Moral hazard is an economist's term for when being insured makes you less careful. If banks are protected from the consequences of making bad decisions, it could make them more likely to make bad decisions. In this case, we are concerned about banks taking on too much risk. If a bank makes a very risky loan and it works out, they get the rewards. But if the loan doesn't work out, the bank depositors' investors are protected, while the cost of failure is covered by the regulators and indirectly by the taxpayers. It's difficult to get around this problem. For normal companies, we count on the investors, those providing funds to the company, to monitor the company to make sure it's behaving properly. However, for banks, the depositors are too small and mostly too financially unsophisticated to monitor the behavior of the bank. Even sophisticated investors, such as bondholders and equity investors, may not have enough information to evaluate the bank's actions. There's a dynamic to this process. One problem solved by regulation leads to new problems. Banks make illiquid and risky loans and so are prone to bank runs. In response, we introduce deposit insurance and too big to fail. And because of those new protections, moral hazard caused the banks to take on more risk. To prevent that, we add increased regulation. The additional regulations can take a number of different forms. There can be limits on activities, such as what kind of bonds or derivatives the bank can hold. There are bank examinations to evaluate the risk a bank is taking. And there are capital adequacy requirements to ensure that banks have sufficient capital. We'll talk about those next. As we saw in an earlier slide, there's a risk that the value of the assets of a bank can fall below the value of its liabilities, making the bank insolvent. Capital, generally money raised through equity, provides a cushion against that happening. However, equity is a more expensive way to raise money than deposits, and so banks try not to have too much capital. Because of that, there can be concern that if banks are holding too little capital, there might be a risk to the banking system. And so regulators have capital adequacy requirements that banks have to meet. These are usually expressed as minimum capital to asset ratios. Of course, not all assets are equally risky. If a bank is mostly holding safe assets, it should need to hold less capital. To take this into account, regulators construct risk-weighted measures of assets. The Basel Accords, named after a city in Switzerland, is an agreement between major central banks on the capital standards they will use when regulating their banks. These standards have evolved over time, so you will hear about Basel I, II, and III. When determining capital adequacy, there are different measures of what counts as capital. Tier 1 capital, often called core capital, is primarily made up of common stock. Tier 2 capital, sometimes called supplemental capital, is made up of preferred stock, subordinated debt instruments, and other items. Total capital is the sum of Tier 1 and Tier 2 capital. Let's do a simple example of a capital adequacy ratio. We have a bank balance sheet with $100 in assets and $95 in deposits and $5 of equity. If the minimum capital to assets ratio is 10%, the bank fails that test since equity is only 5% of assets. It either has to raise an additional $5 of equity and reduce deposits by $5, or if it wants to keep deposits unchanged, raise more than $5 of equity. In this slide, I'll talk about why and how we risk-weight assets. Not all assets are equally risky. Banks that mostly invest in low-risk assets, such as Treasury securities, don't need to have much capital for protection. But banks that mostly invest in high-risk commercial real estate, for example, need to have substantial capital for protection. When determining how much capital banks should have, regulators take into account the risk of each bank's assets. The riskier the assets, the more capital they must have. This is called risk weighting. Another reason for doing this is capital is costly to banks, and so if high-risk assets require the same capital as low-risk assets, banks might be biased to hold more high-risk assets to take advantage of their higher returns. The basic way risk weighting works is that assets are divided into different categories. For example, cash has a risk weighting of 0, so cash holdings count as 0 when determining the total amount of assets. Secured residential real estate loans could have a risk weighting of 50%, so that every $100 of these assets only count as $50 in the calculation of risk-weighted assets. Unsecured consumer loans are riskier and so could have a weighting of 100%. $100 of these loans count fully for the risk-weighted assets. Past due loans are the riskiest, and so 100 of these loans are counted as $150 when we calculate risk-weighted assets. Let's do an example that combines risk-weighted assets and capital adequacy ratios. We'll use the risk weights from the previous slide. Here is the bank's balance sheet. The bank has $100 of cash, which counts for 0 in our risk weighting. It has $500 of secured real estate loans, which are counted as $250. It has $600 of consumer loans, which count as $600. It has $100 of past due loans, which count as $150. Adding things up, the total risk-weighted assets are $1,000. In this case, the risk-weighted assets are smaller than the total assets, but that doesn't have to be the case. A bank engaged in very risky lending could end up with a higher value of risk-weighted assets. Since this bank has $140 of capital, it has a capital adequacy ratio of 14%, $140 divided by 1,000. If the minimum ratio was 10%, the bank would be meeting the requirements. Regulators also want to have a more detailed understanding of how well the bank is managed, and so will perform bank examinations. The banks will prepare statements of the operations of the bank, called call reports, and the examiners will make on-site visits. The acronym CAMELS summarizes what the examiners look for. Capital adequacy is making sure they have sufficient capital. Asset quality is about whether they have problem loans and whether the process for approving loans has sufficient controls. Management is about whether the executive officers are providing sufficient oversight and are working in the best interest of the bank. Earnings is about whether the bank earnings are stable and sufficient to meet its needs. Liquidity is about the bank's ability to meet short-term cash needs. Sensitivity to risk measures how a bank's earnings or the value of their assets would respond if something in the economy changed. For example, what would happen to the bank if interest rates in the economy increased? This video has just provided an overview of bank regulation. In practice, there are a great number of different regulations and multiple different regulators. Banks are regulated at the state level and at the federal level by both the Federal Reserve and the FDIC. Another thing to remember is that regulations are always changing, and there is a certain dynamic to bank regulations. As we saw with deposit insurance, when we see a problem, we introduce a regulation to fix that problem. That regulation introduces new problems, and so we add regulations to fix that. The strictness of regulation also changes over time. We have periods of tightening or relaxation. Often we see an increase in regulation right after a financial crisis. But over time, the financial system changes, making the old regulations less relevant, or banks figure ways around the regulations, until the next financial crisis when the regulators crack down again.